Hello, everybody. Welcome to today's and the latest IMI webinar. Today, we're looking at a Cashflow Clinic. As I'm sure many of you know, these have been challenging times for the industry, and business finances in particular could well be feeling the pinch at the moment. Even official Office of National Statistics data suggests that, over 6% of automotive companies either have no cash reserves or less than a month's worth, which, given what we've all been going through is not an ideal situation to be in. So in today's webinar, we want to talk through how businesses can face these financial challenges and what tools and mechanisms are available to help. And to help us walk through the options, we have a panel of experts. We have, as you can see on the screen, we have the IMI's Chief Financial Officer, Simon James, and he's joined by KPMG Managing Director, Lee Swinerd, and partner at KPMG, Andrew Byrne, as well. Obviously, we've got a very long agenda, not a long agenda, a very interesting agenda to talk through. And the panelists will be taking us step by step through that. Obviously, this is a webinar that's designed for you, and we want you to get as much out of it as possible. So as we're talking through different topics, if you have a question that you feel that you really need an answer to, there's the Q&A function. So pop your question in there, and we'll either try and answer it during the session, or if we can, we'll say 15 minutes towards the end to run through as many of the questions as we can. Obviously, time is always our enemy, so if there's anything that we can't answer over the next hour or so, we will make sure that we get back to you in some other form. But yeah, this is for you, so the more questions you answer, the more that you'll get out of this session. But rather than me carry on for too much longer, I'll hand over to Andrew Byrne, and he can kick things off.
Thanks, James. So hello, everybody. Just by way of an introduction for Lee and I, I'm Andrew Byrne. Lee is one of my colleagues who works with me at KPMG. We both work in the restructuring team at the firm and have done for many, many years, working with companies across a variety of sectors and across different sizes: public sector, private sector, listed companies, family owned, etc. And what we're trying to do today is just, at the IMI's request, just try and give some insights as to the sorts of things that we do working with clients, and certainly with the context of COVID-19, what sort of things that we would encourage you to think about. Now, as we've thought about the presentation, we need to pitch it at a level, because I'm sure there'll be people on the call who are sort of from self-employed through to working for large companies. So please bear with us, and what we will try and do is explain sort of the slightly different approaches dealing with larger companies versus smaller ones. But if you do have any questions, as James says, please shout them out as we go along, and we will try and answer them when we get to Q&A. If I pass over to Lee, who is coming off a mute, and Lee will talk to you about the cash side, and then I'll pick up the other elements about dealing with the bank, funding, and the changes to the Insolvency Act and what that might mean to you.
Hey, thank you, Andrew. Good afternoon, everybody. So I'm going to pick up today initially just around the benefits and the need and the requirements to undertake cash flow forecasts for your businesses. And we'll also have a very quick look at sort of working capital and managing of working capital. So to keep things at a pretty high level, there are two types of cash flow forecasts that are typically prepared by people. The first is what we call the direct method, or the receipts and payments method. And really what you're trying to do there is just track what it says in the title, really. The receipts that you get from every day or every week, and the payments that you make. And it's as simple as that. The indirect method is for where you prepare balance sheets, and typically the way that an indirect forecast is prepared is it's a movement between two balance sheets, and we call that a funds flow forecast or an indirect forecast. And both are have their benefits and merits in different scenarios, and I'll just touch on those now. Again, there are three kind of purposes really for for a forecast. And the first one there is what we call a Treasury receipts and payments forecast. Now, appreciate that not everyone on this call will have a separate Treasury function, right? But for those larger businesses that have a Treasury function and they need to manage cash, then this is about making sure they have the right cash in the right places at the right times. So I won't focus on that. Where we will focus today primarily is on the short-term receipts and payments forecast. This is usually prepared on a 13-week basis. The reason it's based on 13 weeks is that captures a full quarter, because in the UK we have a number of critical payments that typically are made on a quarterly cycle. So the main two being VAT and rent payments. And a short-term receipts and payments forecast is typically prepared on a weekly basis, but it is sometimes prepared on a daily basis as well, and can be done on that scenario. A long-term forecast is really where you get into the indirect method, and you're really looking at what the cash flows of the business will be over a 12, 24, or even 36-month period. That's much more around business planning, and making finance decisions around the business. But as I said, the short-term receipts and payments is the key tool. We recommend that all management teams, whether you are the largest business or the smallest business, undertakes a short-term receipts and payments forecast. The analogy that I use here is it's like trying to drive a car in the rain without the windscreen wipers on. It's pretty hard to see what's coming up, right? If you don't have a cash flow forecast, it's like driving the car without windscreen wipers in the rain. So just think of it like that. All you're trying to do is give yourself enough visibility of what's going on in your business, where the tight points might come, the pinch points might come in terms of liquidity shortfall, or in the worst case scenario where you're saying, actually, I'm going to run out of cash in 3 weeks time, 6 weeks time, 8 weeks time. The more visibility that you have, and projecting that out, then the more options you have of dealing with it. And we'll come on later into the presentation around sort of dealing with your banks and lenders and how you can generate cash for your business. Okay, so next slide, please. So what does a short-term receipts and payments forecast look like? So this is just a typical example. There's no formal right answer or definitive answer, but if you prepared something like this with the receipts at the top, your payments underneath, and then at the bottom something around your the headroom that you have in your facilities, etc., then if you went to your banks with one of these in your back pocket and you showed them something like this, they'd say, oh, okay, you've done a 13-week receipts and payments forecast. It's a very well established tool in the finance sector, finance industry. Banks understand it, banks recognize it, and they say, okay, that's a good starting point. And if you rocked up to a bank and said, hey, I've done my forecast, I'm a bit tight on cash in week 8 of my forecast, blah, 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 can you lend me some more money? Actually, you've already done a good step and sort of demonstrated where you're going to be and how you get there, and and it shows that you are in control of what's going on in your business. So if you go to the next slide, please, where we get to, for us, there are kind of 6 key parts of how preparing that cash flow forecast and what you need to do. The first one just really already run through in terms of structure. So that's sort of receipts at the top, payments underneath, with some an element around your actual bank facilities and the headroom and everything else like that. That's a good structure to follow. And as I said, it's well established and well recognized. Again, the right methodology. This is about making sure that you fully understand that it is done on a receipts and payments basis. I was talking to a business just a couple of days ago where their cash flow forecast was sort of a hybrid between the direct and indirect method, and it was really actually quite hard for us, and I'm experienced in doing these. It was really quite hard for me to understand how the they've blended the two together. And when we look at it, we struggle to understand that it will have an accurate outcome, because of you're not really comparing apples to apples when you blend the two kind of processes or methodologies together. When we talk about the right inputs as number 3 here, so typically in a business, you know, and again, if you know, if you're a very small business, then you'll probably know all of this information yourself. But in slightly larger businesses, you know, the best people to tell you probably what's coming in from the receipt side is your credit control team or your accounts receivables function, right? They understand the customers, they know when the invoices are due, they know when those customers typically pay. So perhaps they do a payment run on the last Friday of every month, and so you get the money on the Monday, you know, and that's a great level of input to get. Same with accounts payable and some of the other line items. You know, if you're talking about payroll, you know, talk to your payroll function or your HR team. If you've got capital expenditure, you know, is there a separate group of people that look, or individual who look after that? And the other thing about getting the right people to input into it is that you can effectively make them accountable and responsible for the line items in that cash flow forecast. So if week on week the accounts receivable team keep overestimating or underestimating, which is more typically the case, the receipts line, then actually you can go back and say, hey, let's have a look at this again. You know, what are you doing? How are you doing it? Let's have a look at the process and the methodology of how you get to those assumptions, and make sure that you learn from your mistakes and sort of reiterate it. Time frame and rests, I've already talked about. Typically it's done on a 13-week basis, and it's done on weekly. So rests is a week, or is it a day? As I said, if you're really tight for cash, then we normally go into daily forecasting for at least the next 2 weeks, and then you fall into weeklies thereafter. I've even done a job last year in the automotive sector where we had to do intraday forecasts because of the timings of sort of large inflows and large outflows, where they might have to have, you know, pressed the button on the backs for the payment runs or the payroll, yet the money hadn't yet come in from a key customer, for example. And then say the time frame, typically you do 13 weeks for the reason I outlined, being it captures all the quarterly payments. But you can do it for longer. You can do it for 17 weeks. Again, I'm just doing one in the automotive sector where we will do it weekly until the end of 2020. So it'll be 26, 28 weeks there or thereabouts. When you get into those longer time frames, you clearly, yeah, it's based off a lot more around, you know, what your forecast sales and your forecast purchasing is going to be. But that's absolutely fine. The later time frames are probably going to be less accurate than the closer time frames, when you know, if you look into your balance sheet today, you'll know that you're owed £500,000 from your customers, and you owe your suppliers £400,000, and you can use that as the basis for the unwinding of the balance sheet and to forecast your receipts and payments. Number 5, typically, this is more relevant for larger groups of companies where you might have multiple people preparing a forecast. You know, maybe a divisional level, or, you know, maybe if you're in a car dealer group at each dealer level, or something along those lines. But again, it's very clear, making sure you have set templates, very clear instructions about what to do, what not to do, how they get to certain assumptions, etc. And then finally, how often do you update this? And part of that is the answer is, you know, what are the rests that you're using? If you're in a distress scenario and you're doing daily, then you probably need to update it daily. If you're in a slightly less distress scenario, then doing a weekly update and always adding in a 13th week to the new forecast, you know, that typically works quite well. And in some businesses, they update it properly once a month. But in that instance, sometimes they'll do a 17-week forecast and only really do the update once a month. So there are a number of options depending on the situation and the circumstance of the business. The other element that we would also include is to do variance analysis as well. So you do the forecast, you say, right, okay, I was going to receive £500,000 in receipts this week. Actually, let's look back at the bank account. We received £400,000 this week. And then you try to understand why there was a delta of £100,000, you know, because that's probably material in that example. And what you're looking to do is learn from your mistakes so that you don't make the same mistakes again, and you get the forecast increasingly more accurate as you do this more often. Okay, next slide, please. So once you've prepared a forecast and you understand that you know, you might have some cash issues or some cash concerns, you know, there are a number of things that you can do here to, you know, looking at your own business about you know, what we would call self-help measures, and looking across the business and seeing, you know, fundamentally anywhere there's an inflow or outflow of cash, is there anything that you can do to either accelerate the receipts of cash, or to delay or defer, or to cancel outgoings of cash? You know, so for an example, on the outgoings of cash at the moment, I'm sure a lot of businesses, you know, have been through lockdown, and discretionary spend has been cut back significantly, etc. You know, and you increase the or you decrease, sorry, on spending the authority limits of who can buy what and who has to sign off at what limits, and those sort of controls. That obviously helps to reduce spend in the longer term. But there's lots of areas, you know, in your accounts receivable, in your inventories, in your accounts payable, areas where you can work to maximize the working capital benefit. You know, are you maximizing the areas around taxes and VAT? And you know, obviously at the moment the government has been quite helpful, has instructed HMRC to allow, you know, this current quarter of VAT not to be paid and can be deferred off for a number of months. But that can happen in a non-COVID world as well. You know, if you cannot afford to pay your payroll taxes or your VAT, you can go to HMRC and ask and request a time to pay agreement, for an example, and things like that. You know, financing, working with your lenders. A lot of automotive businesses have asset-based lending or invoice discounting type facilities. Are there things like deductions or accounts that are blocked, or you cannot get access to, or, you know, non-funded receivables, credit note provisions, lots and lots of different stuff in an invoice discounting facility that eats away at the maximum amount that you can borrow based off your debtor book. Revisit those, because sometimes these kind of provision levels were set 2 or 3 years ago or a number of years ago. And maybe life has changed, and you can talk to your lender and try to get some tweaks and changes therein. You know, property, you know, a number of things in there. One of the classic ones we do, you know, if you've got multi-sites, you know, is talk to the landlords if they're rental properties, and rather than pay quarterly in advance for your rent, can you just move to, say, monthly in advance? And that would smooth the potential peak of your cash flow requirement. Doesn't change the total. Of course it doesn't, but what it does do is, you, instead of spending 3 months in one go, you split that payment in 3. So these are you know, there's lots of areas that you can have a look at. So you know, those are the kind of areas that we just wanted to cover today. You know, as I said, just kind of look at all the inflows and all of the outflows. Andrew.
Yep, thanks, Lee. I mean, just to add to it, to try and bring this to life again a bit more. So as one of the other benefits of using a 13-week cash flow is to look at sort of the peaks and troughs. So actually, how can you move payments around or receipts around in months, so it makes it much smoother? And if you're working to an overdraft or revolving credit facility, how do you, by smoothing things, how do you make sure you've got sort of a bit more headroom than perhaps you might have if you didn't move things around? And to give you an example, so you know, currently we have an OEM. I won't tell you which one, you know, but clearly multi-billion-pound turnover organisation, with every member of staff being mandated that if they spend over £25,000, they need board approval to get authority to actually spend that money. And this is a multi-billion-pound organisation. So you can imagine how tight organisations are actually managing cash, almost as if they were smaller businesses or sole traders. We worked for a well-known news agents a few years ago, and one of the things that we did when we looked at their cash flow, clearly much larger organisation, was to think about how they could smooth their cash flow and move sort of receipts and payments around. And we had a good old battle with the board around what it meant if they had to go and approach a party to move the payment dates that they made payments on to a particular supplier. And finally, we won the battle and went off to talk to the supplier. And the reaction back to the board was, we're surprised you're the only, we've been waiting for you to come and ask us the question because you're the only party in the sector that actually hasn't come to talk to us and hasn't reprofiled things. So sometimes sort of your own inhibitions may restrict your ability to smooth, but certainly with COVID-19, in the current crisis, I would very much say that the rule book's been ripped up. And actually having the conversations and being bold enough to say, look, I want to try and do this, and how do I work with my customers or my suppliers so that my cash flow is much stronger or is much smoother, then certainly what we're finding is certainly a greater level of receptiveness to people working collaboratively so that as many people as possible get through this crisis successfully rather than going to the wall and going to insolvency. Okay, so very much as Lee said, I would strongly encourage you to go through every line of your profit and loss accounts, your cash flow, and think about what could you do to try and change how you're paid or how you receive money so that you build up that balance. And it's not just around making sure you've got enough cash in the bank at the end of the month, but it's also just in case you get hit with a left field surprise, so that at least in the back of your mind, you regularly know, what's in the bank, how resilient is my business. So if I have a customer go bust on me or somebody doesn't pay me, then can I survive, and how much of a hit can I take if I have to? Okay. If we just move on to the next slide, please. So in terms of managing your bank or managing your funder, I appreciate everybody on the call, will have different size businesses and therefore, may have sort of portfolio managers or relationship directors that are working specifically for your business. So some of these comments will be general, but please take the theme. From experience of going through sort of a number of recessions and crises such as this in terms of the financial impact of a crisis, what's very clear is every time we get involved in a situation, the big red line is that the banks just do not want surprises. And whilst people occasionally are reticent about going to talk to the banks because of what might happen if you go and tell the bank you've got a problem, what's very clear in our experience is if you go to the bank with the cash flows and you talk about where you are, and if you have a problem, the more transparent you are and demonstrating that you're trying to do as much as you can yourself, but you need some help, the greater the positive response comes back from the banks. So turning up to the banks at the last minute going, I've got a problem, you need to help me, otherwise I'm going to go bust tomorrow, just as from our experience just doesn't wash. But actually being able to talk to the banks, give them some early warning that there might be a problem coming down the line, or indeed, if you're thinking of expanding the business, certainly if you're talking to clients who focus on selling second-hand cars, there are a number of organisations looking to think about how do they actually build the stock, because certainly anecdotally we're picking up sort of sub 10 grand vehicles are flying out of the auctions, and a lot of people are looking to buy sort of slightly cheaper cars to avoid going onto public transport, and almost that immediate demand of, if I need to go on public transport and I don't have a vehicle, I need to go and buy one now and make sure it's delivered quite quickly. And therefore, for some of the smaller dealerships, they're finding they need to get access to working capital facilities with the banks so they can go and buy the vehicles and appropriately take advantage of the market demand that we're seeing at that level at the moment. So talking to the banks early around what you need. Acknowledge when you've got a problem, as I say, doing it early rather than waiting to the last minute, because the more visibility that people have there's a problem coming, the greater the opportunity that everybody has to work together, and also the greater range of options that are available. You know, the longer you leave it, the bigger the problem could be, and therefore the number of options that are available to you or to the bank sort of diminishes quite substantially. Collaborate, you know, think about sort of talking to the bank, making sure they know what's going on, talk to them regularly. If you produce management accounts, make sure that the narrative is there and they understand the good bits and the bad bits that you've had in your performance over the previous period. And the key point for me here is about optimizing credibility. You know, turning up with the cash flows Lee talked about, demonstrating that you've thought through where there are issues or indeed where you need additional funds to develop or grow the business is really important. We see sort of both ends of the spectrum in our job, where clients turn up and repeatedly keep going back to the banks for waivers against covenants, for small amendments against their banking facilities. And these are organisations that turn over 200, 300, 400 million plus. And you can see when you talk to the banks and the relationship directors, the frustration as to why haven't the management team just thought about this? Come and talk to us once, and then we can tidy up the facilities or deal with their requests in one go, rather than drip feeding the requests constantly and becoming quite needy by doing so. Because what you need to bear in mind is on the other side of the fence, if you're in the bank, you know, producing papers, credit reports, or credit notes back to investment committees, you know, updating the systems all takes time, and therefore working with the bank manager or the relationship director so you understand what they need and when they need it, so that they can brief sort of their bosses sort of and do upward briefings, that they get the information they need to process any requests that you want to make of them. By working together and understanding what they need, clearly ultimately helps you as well, and hopefully serves to provide a stronger relationship between you and your bank and your bank manager. If we move to the next slide, please. So this was one of the questions the IMI asked me the other week around sort of managing your company finances, and the question of debt versus equity if you need monies to either grow the business or to get through COVID-19, because you know your reserves may have been depleted, you may have staff that have been furloughed, you've been trying to keep everything together, but I suspect that a number of you will have sort of money going out of the bank and revenues have been substantially lower than you would have hoped pre-COVID-19. There's obviously pros and cons to both debt and equity. But from experience, the question I always ask clients is, what is it you want to try and achieve? You know, if you want short-term funding, then obviously focusing on debt is a good way to go. But then there's different types of debt as to secured debt, secured against assets, which invariably should be cheaper than unsecured debt, so overdrafts that aren't secured against any asset base, versus equity, which tends to be longer term, and typically more for investment, unless you're into a very distressed situation where there's a high likelihood that somebody wanting to take an equity stake in your business is probably going to want to do it expecting the business is worth not very much. And I suspect if you're an owner of that business, you know, you would have a higher value in mind for the business than it possibly is worth today, sort of having just taken a hit like many businesses through COVID-19. So therefore, it's really important to understand what is it you're trying to achieve. Obviously, debt typically is repaid over an amortized, so repaid on a monthly or quarterly basis, year on year over the mature until the term of the loan comes to an end, whereas equity tends to sit there. But equally, you can have sort of ordinary share capital or preference share capital, where people may sit on shares, get an equity value, an equity stake in the business, but as a preference share still may get a coupon or an interest against the debt that they've, against the equity they've got invested in your organization. Ultimately, you know, again, this is a message that we talk to our clients about time and time again. It's not just about why you want the money, but it's also how you're going to repay it. And what your overall objective is, because clearly taking on debt or indeed equity ultimately needs to be repaid. So even if you're not repaying the equity now, when it comes to selling the business in the future, post-COVID-19, and hopefully many of your businesses have recovered, and then sort of as things have eased, your businesses will start to thrive again, then the value of your business will go up. And ultimately, when it comes to selling your business, if that's what you choose to do in the future, then selling an equity stake now may potentially turn into something quite valuable for a party coming to investing now and then realizing it's on a sale in the future. And it may be at that time that you feel that whatever the business is worth today may not represent sort of the right value for somebody to invest in, and therefore they may feel they've got a killing, whereas you may not feel that that's an appropriate course of action. So certainly, having worked in investment banking and restructuring, you know, my starting point very much for these things is focus on debt first. Think about the type of debt instrument, and then think about equity. But it is very, very important that you think about what the end goal is that you're trying to achieve, and make sure you don't give the family silver away now. I'm just moving on to the next slide, please. So this is a sort of general topic that we just wanted to flag, and we've had similar conversations with members of the SMMT and other organisations, and it's something that we're going to be sort of pushing into the press actually over the next couple of days as a firm. But you may or may not be aware that there's a number of changes coming down the line with regard to the Insolvency Act. So the Insolvency Act amendments are in, I think it's the second reading in the House of Lords at the moment. It is subject to change. We know that there are some changes that will be made to the draft act, the draft bill, before it's put into effect. But the current expectation is that the Insolvency Act will be amended by the end of this month or early July, okay, unless something fundamentally happens in the next few days. If you get bored one night, there's over 200 pages that set out sort of the amendments to the Act. But what I'll try and do is focus on three things today. And this is coming at it from a commercial perspective. I'm not a lawyer, so I'm not giving anybody legal advice. But you may have seen something in the press around directors' duties and wrongful trading, and a relaxation or a suspension of those rules. In reality, sort of wrongful trading means that when a business gets into insolvency or heads towards an insolvency, and the directors believe that they cannot meet their debts as they fall due, and don't have a likelihood of recovering sort of the business and solvently, and therefore they're likely to go into an insolvent situation, such as a liquidation or administration, then they have a responsibility to make sure that the creditor's position does not worsen, okay, either individually as a creditor or collectively. There's a slight relaxation on this in terms of wrongful trading, because going beyond the point where you know that you are not able to meet your debts as they fall due, and therefore you worsen the position, is effectively wrongful trading. And as I say, there's a slight relaxation on that. But what the changes don't do is remove a director's responsibility from making sure that the creditor's position doesn't worsen. So I would say, you know, to a layperson, that in reality it doesn't change very much, apart from sort of the legal challenge that you might get for getting into hot water for wrongful trading. But if you get into a situation where you feel you cannot meet the debts as they fall due, firstly, I would be taking legal advice and talking to an insolvency practitioner. That's not to say that you would go into insolvency, but it's making sure that you have the right protections as a director, just in case something goes wrong. But sticking with the golden rule of making sure creditors' position doesn't worsen, whether the Act changes or not, means that you are doing the right thing. Okay. The two other points I think are probably more key for you to be aware of. So firstly, the moratorium. So at the moment in the UK, then companies will go, directors who don't feel they can continue to trade the business because it's insolvent will apply to court for administrators or liquidators to be appointed, and the company goes into an insolvency process. In France, Spain, Germany, they're called different things. We're calling it Moratorium under the Insolvency Act. In Spain, it's called Article 5 bis. In France, it's the mandataire process. But what moratorium is, it enables directors with a supervisor, so an insolvency practitioner, to produce a restructuring plan. And for the directors, if they believe there is a chance of keeping the business alive, but the business needs to go through a restructuring, then they can go to court and apply to the court for a 20-day moratorium. It can be extended with court approval, but a 20-day moratorium to enable them to try and put in place a restructuring plan to see if they can save the business rather than allowing the business to go into insolvency. Okay, I think this is a really good step forward, because hopefully it enables some companies, probably at the sort of medium to larger end, but some companies to try and avoid insolvency by working with their stakeholders to try and avoid sort of insolvency, save jobs and keep the business going. You know, that's got to be a good thing. The challenge with it is who's going to fund the moratorium, and when creditors find out, your suppliers and customers find out that a business is in moratorium, how are they going to react? And that is untested territories here. So only time will tell in July, August, when this act comes into effect, how many times this is going to be used and whether it's going to have benefits. We all hope it does, but there is no question that there are some practical challenges for organisations trying to effect a moratorium rather than going into an insolvency process. Linked to it is the final point, which is around ipso facto. So ipso facto is effectively the clauses in the revised bill that talk about suppliers, rather than being able to exert leverage and ransom to a company and administration. So, you know, I'm owed X pounds, I'm not going to supply my widgets to you as the administrator or the company in moratorium unless I am paid all my debts, you know, and I'm paid cash on delivery going forward. What the ipso facto does when it comes into effect is effectively means that all the leverage that a supplier has is taken away. So there becomes a legal requirement, unless the supplier can show hardship to a court. And clearly that again is an untested hurdle that we'll need to see how it plays out and how robustly the courts sort of have to interrogate information to work out what hardship means, etc. But on the face of it, it means that suppliers are going to be required legally to continue to supply administrators and companies that are distressed in a moratorium without seeking payment of any outstanding debts, etc. That's a big change for organisations and for administrators. So if you're an OEM car manufacturer, that's probably great news, because, you know, with consequential losses, then if your production lines stop, then actually getting the supply chains coming through the tier 2s and tier 1s to continue to supply has got to be a positive step forward. The worry that I have, and you appreciate the reason why we've linked this together with the cash flows, I'm sure, is that what this may do is actually accelerate people taking action faster. So I'm hopefully not alone in my view that with the way I've described it, certainly if I was a chief executive or a managing director of a business supplying a company that I even thought was likely to go into insolvency or moratorium, and I was starting to pick up noise on the grapevine, then I will probably start to reduce my payment terms so that I started winding in my exposure, my credited exposure to that company, or indeed just expecting payment on delivery, so that I could protect my business and not take the risk that the company went into insolvency and I wouldn't get repaid, or similarly with a moratorium process. So the risk here is in the automotive sector that suppliers further down the supply chain will take action, preemptive action, to make sure that they understandably protect themselves, particularly when at a time such as this, cash is very tight and people do not have the reserves and cash in the bank to take sort of too many, if any, hits to their businesses. So the one piece of advice, whether you're a small business or a large business here, is in terms of ipso facto, it's very important, we think, that you start looking at your customer base and try and be very clear to understand, with whatever source of information you can access or direct conversations with the customers, to understand how creditworthy those organizations are. And relying on things like Dun & Bradstreet or Euler Hermes, or so credit rating agencies, at the moment potentially is a risk, because many of these organizations use financial information that clearly is historic by its very nature. And as you will know from your own businesses, you know, if we were to look at your financial position pre-COVID-19 versus what it is now, it will be very different, and it's unlikely for your own organizations that there is much information in the public domain. So looking back historically at financial information for many companies at the moment could be misleading and might lead people to the wrong conclusion if they're thinking about credit ratings or how much credit they're prepared to give a customer. Okay, so appreciate there's lots to think about there, and I'm conscious that we're 40 odd minutes into the presentation, but hopefully that has given you quite a lot to think about. If we just move on to the last slide and I sum up. So the 3 top tips for optimizing your business and cash flow, and hopefully this doesn't come as a surprise given what we've talked about for the last sort of 40 odd minutes, but in terms of cash flow, forecast regularly. I'd say it's no different to being at home, you know, and thinking about doing your own personal budgeting. You know, you're going to buy a house and get a new mortgage. You know, you probably look at your own budget and understand sort of how much you've got to spend, you know, on a house and how you could afford the mortgage. It's the same sort of thing in business, and making sure that you have regular visibility on how much cash you've got in the bank, when more money is coming in, and where your pinch points are so that you can manage them. Okay. In terms of COVID-19, make sure that you've maximized your own reserves, and I'm sure many of you are very good at doing this anyway, but going through every line of the profit and loss account. So what can you do to minimize or reduce the costs that you've got? You know, have you bought some assets in the past, you know, bits of kit or machinery that you've actually never really used, that's been parked in the side of the building for a while? You know, is now the time to sell it and actually turn it into cash, because you're better off having cash rather than an asset sitting there unused. What's the cash flow? You know, what can you do around the cash flow to reschedule it, so that you make sure your receipts are coming in at the start of the month using an exaggeration, and your payments going out at the end of the month, so that you're maximizing your cash position throughout as much of the month as you can. And then finally, in terms of funding, think about matching the funding, whether it's debt or equity, to your objective. And as I said earlier, really think about what is the long game for you, and therefore what is the best type of funding that you need, and to what objective. So is it growth monies? Is it emergency funding? But don't just focus on the short term. Please think about the longer term and how you can repay it back, and what it means once we get through this crisis, and we will, to your business, so that you don't effectively overpay for money that you might need to access now. So hopefully that's helpful, James, to your members, and happy to take any questions.
Perfect. Yes. Well, thank you, Andrew and Lee, for the presentation. There was an awful lot to take away from that, and I hope that people that are tuning in have got a lot out of it. It's definitely food for thought. We've got the Q&A session now. So if you do have any questions, feel free to submit them. This is your chance to ask them, both Lee and Andrew directly, and Simon, of course, as well, from the IMI. And use the Q&A box down below to send them over. I do have the first question though, and it's a bit of an elephant in the room, maybe for people coming in, which is KPMG is a very large company itself, and your clients typically are very large companies as well. So how relevant is the stuff that you've been talking about to smaller businesses, sole traders, for example?
Yeah, I'll go first, and maybe Lee can chip in as well. I think it's very relevant. You know, what's a smaller organization wouldn't want to do is spend a lot of time producing cash flows. You know, doing it day in, day out is probably not necessary. But having visibility, irrespective of your size of organization, is really important. And we've worked with organizations doing this with turnovers of a few £100,000 up to up to multi-billion pounds globally. And whenever we do it, or clients sort of take on the advice that we've suggested around cash flow forecasting, they always find value in it. And the most important thing around it, as I've said, is almost using it as a way to have visibility, build credibility with your funders, and using it as a way to almost challenge yourself as to, right, if I've got a problem coming down the line, what are all the things that I could do to try and improve my cash flow, and almost constantly having that list in the back of your mind, just in case you have a problem coming down the line. And how do you take action? And absolutely, larger companies can go and talk to revenue customs around doing time to pay arrangements, but that option is still available for smaller companies as well. But it's being, excuse my French, but it's having the balls and sort of not limiting yourself in terms of what you're prepared to ask for, to try and make sure you protect your own business and your cash flow.
I'd just add to that, Andrew, as well. I think, you referenced it. Yeah, everyone does this to a larger or lesser extent in their personal lives as well. You know what your incomes are every month. You know what your broad outgoings are, etc., etc. So if you do that on a personal or a family level, why wouldn't you do it at a business level, whether you're a sole trader or a multi-million turnover business? So and personally, I think that good cash flow forecasting is it's irrelevant of size of company. It's giving you that visibility to manage your business. That's the the key output, and that from having such a tool available.
Can I ask what would you recommend maybe for the really sort of the smaller end, the sole trader, etc., that would actually want to get some more detailed forecasting up and running? How would you suggest that they go about it?
I would start by just, again, thinking about what do they think, if you go back to the sort of the template we put up on the screen, your receipts and your payments, break it down into those buckets. You might have different types of receipts, and so you start thinking about that. Okay, I'm a backstreet garage, repairing cars. So what, okay, I've got customers coming in, what do I think my income is going to be this week, next week? Look at my, my list of bookings and say, I've got Fred Bloggs, Joe Smith and Mrs. X coming in this week. That's £200 per service, blah, 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 right? To do that, I then need parts, and I've got, got to pay for parts. I've got to pay for this, and I've got to pay for that. I've got to pay my rent. I've got, all of this stuff, and just kind of break it down into those kind of key line items, Simon, and say, and then just start plotting it out, going, oh, okay, I've got to pay, 250 quid a week in rent to my landlord, or 250 quid a month to my landlord. So I know that's on the first of the month, that goes out by direct debit. So let's plot that in, and just use that kind of basic template structure, and then just start plotting the numbers in, and fill it out that way. Yeah, brilliant. I guess also going back maybe to prior year or prior month, to get a feel for when some of the big expenditure items might come in, or maybe some of the big income, because actually I know even something like being given permission to delay payment of VAT, I think for some organizations actually is quite significant. It's got quite a big it's a big outgoing, and actually that sort of thing that you can see maybe historically is worth taking advantage of. But let's not forget with deferring payments means you still have to make the payment at some point in the future. So you need to be realistic. What you're doing is trying to buy yourself some time, so that the business starts returning to perhaps something like normality, and you have regular cash flows in and out. But at some point, whether it's next month, the month after, or in March 2021, you'll still have to pay that VAT liability. So people shouldn't forget that needs to be factored in as well. Yep. Okay, that's helpful. We've got a question from one of our members about do you think HMRC would listen to a time to pay for corporation tax due, and would you take this step as a precaution to protect liquidity cash reserves while we emerge from the crisis? From my experience, Simon, yes, they will. I think, again, to avoid what Andrew said about, you know, when talking to banks, talking to HMRC is equally the same when you have that kind of type of stakeholder. You want to go to them with your best shot at this, right? So you want to have some information available. And if the corporation tax is the only thing that's outstanding, and you can keep your VAT and your PAYE up to date, then yeah, I'm sure they'll you know, at the moment they would listen to that, you know, to do a time to pay. Equally at the moment as well, if you owe tax for last year and your business is forecasting to make a loss this year because of COVID and everything else, I'm not a tax expert, but there are plenty of tax experts either within KPMG or your own firms of auditors and accountants who can give you some advice about actually, is there a way to mitigate that tax liability in the first place so that, you know, it doesn't become due. It's not my area of expertise, Simon, but, you know, as we said, there's always ways that you can look at these things. You know, can you get R&D tax credits, you know, and R&D tax credits, as an example, is not just about men in white lab coats and test tubes. You know, it's about anything, you know, potentially that you can do. Do you have the right allowances for, you know, capital allowances and all of that kind of stuff, always part of a tax computation, of course.
Yeah, no, absolutely. What, Andrew, to your point around these new Insolvency Act measures, well, what sort of impact do you think they might have on some of the small and medium-sized operators in our industry, and particularly the ipso facto, which is quite an interesting one? You're on. That's it. You're on mute, Andrew.
All right, sorry. It's difficult to tell, but it's certainly something that people have to be very mindful of. What I would say is, having sort of done insolvency work myself and dealt with OEMs who are dealing with companies in administration in terms of their supply chain, what you tend to find is, and there's no rule of thumb to this, so this is a general comment, but what you tend to find is for smaller organizations that have relatively small amounts of money owed to them, the first thing is that the administrators and probably the stakeholders do not want to let smaller companies go into insolvency. Okay, there's no requirement for them to do anything, but just the simple fact of, you know, if you have a long tail of small suppliers that are owed, you know, a small number of hundreds of pounds or thousands of pounds, then sometimes it's easier just to write a check to get rid of, you know, the exposure and the noise from all the smaller suppliers, so that you can focus your efforts on dealing with the bigger suppliers. Okay, now you can't, people can't sort of use that and go to the administrator and say, well, that's a requirement, because it's not. But there is something around, almost, if you're making a bit of a nuisance of yourself, actually just paying you some money to go away, because you've got to bear in mind that the administrator staff, you know, the administrator will be charging however many hundreds of pounds an hour for their staff to be dealing with problems. And therefore, some of this comes down to cost benefit analysis, that what you don't want to do is tie up your staff and incur lots and lots of cost in an insolvency process, dealing with smaller suppliers who are owed relatively small amounts of money, when it almost becomes more efficient just to write checks for smaller players. Certainly if you need them for trading, continue trading, and then you can focus your efforts on selling the business, you know, and dealing with some of the bigger suppliers with greater exposures.
Yeah, no, that's helpful. Do you think there could be
sorry, Simon, the other thing that I would add to that as well is, actually it could put quite a lot of pressure on the cash flow of small companies as well. You know, so if you've not been paid, if you give a company 60 days of credit, and typically, and then effectively they're not going to pay you for something that you've paid for, but you still under the ipso facto have to continue to supply them for, you know, during the moratorium period or in administration, actually could be really quite harmful and damaging to a small business's cash flow as well. And I don't think things that those sort of consequences have, you know, have been thought through as part of the legislation.
Yeah, no, fair point. Do you think through this time of crisis there could be opportunities that, for again, particularly for the small and medium-sized, opportunities that could then be maybe a new way of operating that actually is more advantageous, you know, going forward? Can you see some opportunities here?
Absolutely, and I think that's a really good point, because, there's a danger with all of this that we talk about cash flows to be defensive in case there's a problem, and not a surprise because of the crisis that we're in at the moment globally. But there will be opportunities, and it's the right balance that you're bringing to it, Simon, in terms of, we've repeatedly had conversations with clients who are talking about wanting to collaborate more. And doing it appropriately. Large organizations have to be very mindful of the antitrust regulations, but actually working out how to collaborate. And for smaller organizations, in the local area, actually, how can you work together to support each other? Because, whilst there might be healthy competition, I'm sure the last thing you want to do is sort of destroy and wipe out the organization down the road, because the market should be big enough for many organizations to be operating healthily and working together. There will be companies that go into insolvency, or people that just decide to give up because it's too hard. And therefore, if you're in a fortunate position where you've got reserves, or you've got funds available with the bank, and I'd be talking to the banks if you're focused on growing your business, around, are there opportunities for the banks and funders to help you, so that if X, Y, and Z down the road goes into insolvency and you've really wanted that business, or you think there's something in that business that could add real value to your own, to be in a position so that if that opportunity arose, you can take advantage of it and grow your business sort of as we come out of the crisis. And moving from, and it's a crass phrase, but moving from survival to, surviving to thriving is going to be really important. And we, as I say, we've talked to sort of a number of FTSE 100, FTSE 25 companies, and the message that their management teams are giving to their staff is around, we want to come out of this crisis stronger than when we went into it.
Yep. Yeah. That's helpful. Are there any other sort of trends or activities that you're seeing or hearing across the sector that actually, I mean, you mentioned one thing about one of your clients going to its supplier to talk about a rephasing payments. Yep. Is there anything else that you're seeing or hearing that you think actually that'd be quite useful to share? That actually people think, well, you can never do that, but actually in these times, maybe that is the new norm and worth looking at? So
I think there's probably sort of three things that I'd flag. One is we're picking up in the automotive sector in particular a greater desire to use supplier finance, so effectively off balance sheet financing, to try and inject working capital into the supply chain. And some of the OEMs are actively embracing that and signing up sort of funders to do that. Secondly, for probably medium-sized to larger organisations, we're starting to hear noise about people looking to effectively use their intellectual property and how you commercialise it. So can you charge royalties? Certainly where organisations might need to work together to do research and development. When they can't afford to do it on their own and keep the businesses moving forward. So we're seeing activity around that. And then thirdly, it's very much in the supply chain of the automotive sector around concerns of sort of tier 2s, tier 3s, etc., sort of going into insolvency because the volumes of car manufacturing sort of being so substantially lower than it was pre-crisis. Then what does that mean for the tier 1s? If you're a manufacturer and operating at X% of your normal utilization, you may just not be cash generative by doing that, and that will have a knock-on effect as you go down the supply chain to some of the smaller players, and that very much is uppermost in people's minds as to and a real genuine concern as to how the automotive supply chain is going to survive over the course of the next couple of years.
Yeah.
Okay, thanks very much. Unfortunately, with all of these things, we've come to the end of our time, so it's just about 3 o'clock. And but thank you very much, Andrew, Simon, and Lee, for everything that you've discussed and presented during today. There's some useful links on your screen now for everyone watching. The IMI COVID Hub has every update that you could ever wish for from the IMI, and will include in the not too distant future this webinar as well. So if there's anything that you want to go over again or rewatch, then feel free to log onto the website and watch again. Obviously, there's the government website too, and then the KPMG COVID-19 website will also have a lot of useful links to it, that could prove useful for you. So once again, thanks again for our panelists from KPMG to Andrew and Lee, and also Simon from the IMI. And for everyone that tuned in, thanks for watching, and we'll see you again on the next webinar.
Thank you all.